fascination with investing began when I was in my 20s. My brother, Andrew, and I had sold an apartment that we owned in London.
Are you ready to unlock the secrets insiders don't want you to know? Insider trading can make or break your investments. From Warren Buffett's smart money moves to the Martha Stewart scandal, the world of stocks is full of hidden truths. Don't miss out on the strategies that could give you the upper hand. Your next big investment move is just one insight away. Insider trading. In the world of finance, insider trading is one of the most debated topics. It refers to buying or selling stocks based on confidential, non-public information. While it can be a profitable strategy, it's illegal unless the trader has access to public information. In 1980s, financial markets were largely unregulated and insider trading was rampant. Traders often had early access to critical company data, allowing them to make profits before the news reached the public. However, with increasing awareness, governments worldwide tightened regulations. The Securities and Exchange Commission, SEC, a key regulator, began cracking down on illegal activities. Celebrities like Martha Stewart were involved in famous cases. Stewart's case in 2001 led to a massive public discussion on insider trading. She was accused of selling her stocks based on confidential information, resulting in a conviction. Though she didn't serve jail time, the case highlighted the risks of insider trading. Today, the rules are clear. Investors can only act on public information, ensuring fair play in global markets. But insiders, with their privileged knowledge, still hold power in shaping stock prices. Smart money. In the global stock market, the term smart money refers to investments made by institutional investors, such as hedge funds, mutual funds, and pension funds. These investors are seen as having more experience and resources, often making smarter, more informed decisions than the average retail investor. One prominent example is Warren Buffett, the legendary investor known for his successful long-term investment strategies. He has consistently outperformed the market by focusing on value investing, analyzing companies thoroughly before investing. In 2020, during the COVID-19 pandemic, smart money shifted focus. Investors like BlackRock and Vanguard moved significant amounts of money into technology stocks, recognizing the potential of companies like Apple and Microsoft. Their early investments in these firms paid off when stock prices soared. For savvy investors, understanding smart money flows can be crucial. By analyzing where these institutional players are putting their money, retail investors can gain insights into which stocks may have strong potential for growth. Investor psychology. Investor psychology plays a critical role in how markets behave. Emotions such as fear and greed often drive stock prices more than logical analysis. This phenomenon, known as behavioral economics, shows how investors' decisions are influenced by their feelings, biases, and herd mentality. In the 2008 financial crisis, many investors sold stocks in panic, leading to a massive market collapse. However, savvy investors like George Soros capitalized on the fear, betting against failing banks and making billions. On the other hand, during 2020, as markets were hit by the COVID-19 pandemic, some investors ignored the risks, buying into the market due to the fear of missing out, FOMO. Stocks like Tesla surged as retail investors piled in. Understanding these psychological trends can be key for successful investing. Recognizing when emotions take over can help investors avoid making impulsive decisions and lead to smarter, more calculated actions in the market. Insider tools. For savvy investors, tracking insider transactions is crucial to understanding the true health of a company. Insider trading can reveal hidden information about a company's future, often before it becomes public knowledge. To do this, investors use tools to track the buying and selling patterns of insiders, such as CEOs and other high-ranking executives. One popular tool is the SEC's Form 4, a document that discloses when an insider buys or sells shares of their own company. By analyzing the timing and volume of these trades, investors can often get clues about the company's future direction. In 2021, there were spikes in insider buying among tech companies like Amazon and Nvidia, suggesting optimism about future growth. Investors who closely monitor these patterns may gain an edge by mimicking the trades of those with the most knowledge about the company. Understanding and using these tools helps investors identify opportunities and potential risks before they become apparent to the general public. Corporate governance. Corporate governance refers to the systems and processes that control and direct companies. It's critical for stock performance because good governance can lead to stability and growth, while poor governance may result in scandals and financial collapse. Insider activities often reflect the strength of a company's governance. In 2017, Volkswagen faced a scandal involving emission cheating. The company's weak governance allowed insiders to manipulate data, causing a dramatic drop in stock price. This incident was a wake-up call for investors, highlighting the importance of strong governance structures. On the other hand, companies with solid governance, like Microsoft, often see long-term stock growth. The transparency, ethical practices, and active oversight by boards of directors contribute to better financial performance, attracting smart money. Investors who assess corporate governance can make better decisions, recognizing when a company is likely to thrive or when hidden risks may lead to significant losses. Global regulations. Global stock markets are shaped by varying insider trading regulations, which impact how stocks are traded across borders. Different countries have unique laws governing insider activities, making it crucial for investors to understand these rules before acting on inside information. For instance, in the United States, the Securities Exchange Act of 1934 created the foundation for insider trading laws, enforced by the Securities and Exchange Commission, SEC. Meanwhile, in Europe, the Market Abuse Regulation, MAR, introduced in 2016, ensures that insider trading is prohibited across the European Union. However, in countries like China, insider trading laws have traditionally been more lenient, and enforcement can be less strict. This has led to different market dynamics and investor behavior compared to more regulated markets. Savvy investors must stay informed about these global regulations to ensure compliance and mitigate risks. Understanding how insider activities are regulated worldwide can provide insights into market trends and prevent legal complications. Case studies. Studying famous insider trading cases can provide valuable lessons for investors. These real-world examples highlight how insider knowledge can significantly influence stock prices and market behavior, but also the consequences of unethical trading. One of the most famous cases is that of Martha Stewart in 2001. She was accused of selling her shares in a company based on non-public information about an impending decline in stock prices. Stewart was convicted of obstruction of justice and lying to investigators, although she didn't serve jail time. The case sparked widespread discussions about ethics in the financial world. Another key case is the Enron scandal of the early 2000s, where executives used insider information to hide the company's financial troubles. The eventual collapse of Enron led to significant losses for investors and a revaluation of corporate governance and insider trading laws. By learning from these cases, investors can better understand the risks associated with insider trading and the importance of ethics and transparency in the stock market. Ethical dilemma. Insider trading presents a significant ethical dilemma for investors. While some may argue that it's a smart way to profit from privileged information, others believe it undermines the fairness of the stock market. The key issue is whether it is right for insiders to profit off knowledge that hasn't been made public. In 2001, the case of Martha Stewart raised major ethical concerns when she was accused of selling her shares based on non-public information. Critics argued that this violated the trust of average investors who don't have access to the same privileged data. On the flip side, some investors believe that trading on insider knowledge is just part of the game. High-profile investors like Carl Icahn and George Soros often leverage private insights, sometimes pushing the ethical boundaries. This ongoing debate highlights the fine line between ethical investing and exploiting confidential information for personal gain. For many investors, finding a balance between maximizing returns and maintaining ethical standards is crucial for long-term success in the market. Don't let the next big market trend pass you by. If you want to stay ahead of the curve, hit that subscribe button and be the first to know about the top investment trends in 2025. In our next video, we'll explore how to position yourself for the future of finance. Make sure to tune in. You won't want to miss it.